If you observe carefully what's happening in real estate markets across America right now, you'll notice something that doesn't make sense at first glance. Home prices in many markets are holding steady or even rising slightly, while inventory sits at near record highs in certain regions. Mortgage rates have climbed to levels we haven't seen in over 2 decades, yet the market hasn't crashed. For most people, this looks like resilience. They see it as proof that real estate remains a safe store of value. But when you understand how markets signal future conditions, you realize this pattern isn't showing strength. It's revealing a fundamental transformation in how wealth will be distributed over the next 2 years. The question isn't whether real estate will remain valuable. The question is who will be able to hold on to it and what it will actually buy when the transition completes. This isn't a prediction. It's a logical consequence of observable forces already in motion. I've spent more than 40 years studying how debt cycles, currency devaluation, and asset repricing interact across different economies and time periods. When you understand incentives, you understand behavior. And right now, the incentives facing homeowners, banks, municipalities, and the Federal Reserve are pointing toward an outcome most Americans aren't prepared for. Consider 3 data points. First, the total U.S. mortgage debt stands at approximately $12.5 trillion, with roughly $10 trillion of that locked in at rates below 4%. Second, property tax revenues have increased an average of 6.8% annually since 2020 in major metropolitan areas, even as services decline. Third, the dollar has lost 22% of its purchasing power since 2020, when measured against a basket of essential goods, including food, energy, and healthcare. These aren't random statistics, they're connected pieces of a larger mechanism. To understand what real estate prices are actually revealing, you need to understand the difference between nominal prices and real prices. Your home might be worth $500,000 today and $550,000 in 2 years. That's a 10% nominal gain. But if the currency loses 25% of its purchasing power during that same period, your real wealth has declined by 15%. This is the hidden mechanism that transfers wealth from savers and asset holders to debtors and governments. Real estate appears to hold its value because the numbers go up. But numbers going up in a depreciating currency isn't wealth preservation. It's wealth confiscation through inflation. Think of it like a seesaw. On one side sits your property's dollar value. On the other sits the dollar's purchasing power. As the dollar side drops, the property value side rises to maintain balance. But you're not getting richer, you're staying in the same place while the ground beneath the entire seesaw sinks. What most Americans see is their side of the seesaw going up. What they don't see is that both sides are descending together. The current pressure on this system comes from 4 simultaneous forces. First, the federal debt now exceeds $36 trillion. With mandatory spending consuming 73% of tax revenues before any discretionary spending begins. The government must keep issuing debt, which means the Federal Reserve must eventually accommodate that debt through some form of currency expansion. Second, commercial real estate faces a $1.5 trillion refinancing cliff between now and 2027. With office buildings in particular valued at 40 to 60% below their 2019 levels in many markets. Third, insurance costs for homeowners have spiked 30 to 50% in high-risk states, with major insurers withdrawing entirely from Florida, California, and Louisiana markets. Fourth, the demographic reality of 74 million baby boomers moving from their peak spending years into retirement means sustained downward pressure on consumption and tax revenues. Each of these forces alone would stress the system. Together, they're creating conditions that will fundamentally reprice real assets relative to currency. History is an excellent teacher if you're willing to study the patterns. In 1971, when Nixon closed the gold window, homeowners saw property values rise dramatically over the following decade. Between 1971 and 1980, median home prices increased from $25,000 to $64,600, a 158% nominal gain. People felt wealthy, but when you adjust for inflation, real home values only increased about 8% during that entire decade. The wealth wasn't being created, it was being redistributed from those who held currency and bonds to those who held hard assets and owed fixed-rate debt. The homeowner with a 6% mortgage locked in during 1972 paid back the bank with dollars worth half as much by 1980. That's a real transfer of wealth. During the 1970s inflation period, something else happened that's particularly relevant today. Property taxes exploded. Municipalities saw assessed values climbing and raised millage rates to capture that apparent wealth. In many California counties, property tax bills tripled between 1975 and 1978, which led directly to Proposition 13 and a tax revolt. The nominal value of homes was rising, but the actual wealth of homeowners was being extracted through taxation on phantom gains. Consider what happened in 2008. That crisis is remembered as a real estate crash, but the mechanism was different than what we face now. In 2008, the problem was excessive debt creation against inflated asset values. When values corrected, the debt remained, creating insolvency. Banks failed. Foreclosures spiked. Home prices fell 30 to 40% in nominal terms. But here's what most people forget. By 2012, just 4 years later, the Federal Reserve had expanded its balance sheet by $2 trillion through quantitative easing. By 2013, home prices in most markets had recovered to 2006 levels in nominal terms. But the currency had been debased. A dollar in 2013 purchased roughly 12% less than a dollar in 2006. So even though your home price recovered, your real wealth hadn't. This pattern repeats because it serves specific interests. It allows governments to reduce real debt burdens. It allows banks to maintain book values on assets. And it transfers wealth from savers to debtors without obvious taxation. Go further back to Weimar Germany in the early 1920s. Real estate owners watched their property values soar to billions, then trillions of marks. They felt protected from inflation. But when hyperinflation ended with currency reform in 1923, those who had borrowed against their properties in worthless marks and those who had held productive farmland retained real wealth. Those who simply owned residential property and believed the rising prices meant wealth preservation discovered their holdings had lost 90% of real value when measured against gold or foreign currencies. The nominal prices meant nothing. The purchasing power meant everything. In every historical case of significant currency debasement, real estate serves as a partial hedge, but only for certain types of properties, and only for those who understand the mechanism and position accordingly. To understand what's coming, you need to understand 3 fundamental principles. The first principle is that all fiat currency systems eventually face the choice between default through deflation or default through inflation. Governments always choose inflation because it's politically easier. Default through deflation means bank failures, mass unemployment, and social unrest that governments get blamed for immediately. Default through inflation means a slow erosion of purchasing power that can be blamed on external forces, corporate greed, or foreign adversaries. The pain is distributed over time and obscured by rising nominal values. Given that the U.S. government cannot service its existing obligations without continuous debt issuance, and given that foreign buyers are reducing their purchases of U.S. treasuries, the Federal Reserve will ultimately need to monetize more debt. This doesn't require conspiracy, it requires arithmetic. When you need to roll over $7 to $9 trillion in maturing debt annually while running $2 trillion deficits, there's only one path forward. The second principle is that during currency debasement, not all real assets perform equally. Productive assets that generate cash flow in rising nominal terms outperform. Farmland that produces food, energy assets that produce fuel, income-producing rental properties in economically strong regions. These maintain and grow real value. Residential real estate that you occupy produces no cash flow and carries increasing costs through property taxes, insurance, and maintenance. It's a store of value, but a leaking one. The worst position is residential real estate with high property taxes in declining economic regions. You're paying increasing costs in nominal terms while the real value slowly erodes. Think of it like owning a dam. A hydroelectric dam generates revenue that rises with inflation. A decorative dam just holds water and requires maintenance. Both are real assets, but only one protects purchasing power. The third principle is that the transition period creates specific winners and losers based on debt positioning and asset quality. Those with fixed-rate debt against productive assets win. They borrow in today's dollars and repay in tomorrow's devalued currency, while their assets generate rising nominal income. Those with no debt against non-productive assets face a slow squeeze. Their property taxes rise with assessed values. Their insurance costs spike. Their maintenance costs increase with inflation. but their asset generates no offsetting income. They're forced to draw down other savings or sell the property to cover rising expenses. This is how wealth transfers from the middle class to those who understand the mechanism, not through conspiracy, but through predictable mathematical consequences of currency debasement. Let me tell you a story that illustrates this pattern. In 1975, two families lived in adjacent homes in a suburban Philadelphia neighborhood. Both homes were valued at $45,000. The Johnson family owned their home free and clear. They were proud of having no debt and viewed their paid-off house as financial security. The Martinez family had purchased their home with a 20% down payment and carried a $36,000 mortgage at 8.5% interest. By 1985, both homes were worth approximately $115,000 in nominal terms. The Johnsons felt they had gained $70,000 in wealth, but their property taxes had increased from $1,200 annually to $3,800. Their insurance had tripled. Maintenance costs had more than doubled. They had no offsetting income from the property. Meanwhile, the Martinez family was still paying their fixed $340 monthly mortgage payment, an amount that had become trivial as inflation pushed wages higher. Their nominal equity had grown from $9,000 to $79,000. But more importantly, they had effectively paid off most of their mortgage with depreciated dollars. By 1990, when both families considered their positions, the difference was stark. The Johnsons had a valuable asset, but faced a retirement where rising property taxes and insurance would consume an increasing share of their fixed income. The Martinez family had nearly free housing with minimal remaining debt service. This isn't made up, it's the typical pattern when currency debasement rewards debtors and penalizes savers. Now let's translate this to what really matters, how this affects you. If you're 55 years old with $800,000 in retirement savings and own a $450,000 home with no mortgage in a state like New Jersey or Illinois, you face a specific squeeze over the next 24 months. Your property taxes currently run about $12,000 annually. As your home's assessed value rises to $500,000 or $525,000 by 2026, those taxes will increase to $14,000 or higher. Your homeowner's insurance, currently $2,800 annually, will likely reach $4,200 as insurers reprice climate and liability risk. Maintenance costs that ran $6,000 annually will approach $8,500 as labor and material costs rise. You're looking at an increase from $20,800 in annual housing costs to approximately $26,700, a 28% jump. Your home's value might rise 11% in nominal terms, but your carrying costs rose 28% while generating zero income. Meanwhile, your $800,000 in retirement savings, if held in a conventional 60-40 stock bond portfolio, will face pressure from higher interest rates, depressing bond values, and inflation eroding purchasing power. A plausible scenario shows that portfolio declining to $720,000 in real terms by 2026, even if nominally stable, purely from currency depreciation. You went from $800,000 in financial assets plus a paid-off house to $720,000 in real financial assets plus a house with 28% higher carrying costs. Your net position deteriorated even though nothing crashed. Based on these principles, here are practical guidelines. First, evaluate whether your primary residence is in a high-tax, high insurance cost region with declining economic fundamentals. If you're in states like Illinois, New York, New Jersey, or California with property taxes above $8,000 annually and insurance costs rising faster than 10% per year, consider whether that location serves your long-term wealth preservation. This doesn't mean sell immediately. It means understand the real cost trajectory. Second, if you're holding significant equity in a non-income producing property, consider whether strategic debt positioning makes sense. A reasonable approach might be 40% of your property equity maintained as equity, 30% converted to a fixed-rate home equity line of credit that you hold but don't immediately deploy, keeping that option available as the currency situation develops. Third, diversify real asset holdings toward income-producing assets. A balanced allocation might look like 25% in your primary residence, 25% in productive real estate through REITs or direct ownership of rental properties in economically growing regions, 15% in Treasury inflation-protected securities, 15% in precious metals as monetary insurance, 10% in energy and commodity exposure, and 10% in international diversification. Fourth, understand what to avoid. Don't chase nominal home price appreciation by upgrading to a larger house with higher carrying costs, unless it produces income or serves a specific life purpose. Don't assume property values will rise fast enough to outpace the carrying cost increases. Don't hold all your wealth in a single residential property in a single location. Fifth, implement changes gradually over 6 to 12 months. Sudden moves during market stress lead to poor pricing and emotional decisions. If repositioning makes sense, begin now while markets remain relatively stable. Sixth, prepare psychologically for the disconnect between nominal values and real wealth. Your home's appraised value might reach $550,000 while your real purchasing power declines. Don't let rising nominal numbers create false security. Seventh, watch for the common pitfall of paralysis. The analysis makes sense, but fear of making the wrong move leads to making no move. Doing nothing is itself a decision to accept the current trajectory and its consequences. Nothing in this constitutes specific financial advice. Each person has different circumstances, time horizons, tax situations, and personal priorities. These are principles and frameworks, not recommendations for your individual situation. Consult qualified professionals who understand your complete financial picture before making significant decisions about real estate or asset allocation. What real estate prices are revealing about 2026 is this. The system is transitioning from an era where nominal price stability meant wealth preservation to an era where currency debasement makes nominal prices meaningless. Your home might be worth more in dollars, but if those dollars buy progressively less, you haven't preserved wealth. You've maintained an illusion while real purchasing power eroded. The choice is yours. But remember what major institutions are doing. Central banks globally have increased gold reserves by 1,100 tons annually for the past 3 years. Sovereign wealth funds are shifting from bonds to real assets. Large family offices are increasing allocations to productive real estate, farmland, and hard assets. These institutions aren't acting on predictions. They're responding to observable incentives and mathematical necessities. They understand that when governments face the choice between defaulting explicitly or defaulting through currency debasement, they always choose the latter, and they're positioning accordingly. That's why this channel exists, not to create fear, but to observe signals before they become obvious to everyone. By the time real estate's role as a partial inflation hedge becomes common knowledge, the best positioning opportunities will have passed. By the time the middle class broadly understands that rising nominal home values don't mean rising real wealth, the wealth transfer will be substantially complete. We observe carefully, we study historical patterns, we understand incentives and mechanisms, and we share that analysis so you can make informed decisions based on principles rather than headlines. If this framework makes sense to you, if you value analysis that connects observable data points to historical patterns and logical consequences, subscribe to this channel. The signals are already visible for those willing to look. What happens next isn't mysterious. It's the predictable outcome of forces already in motion. The question is whether you'll position for the world as you wish it were, or the world as it's actually becoming.